Freedom Builders, and welcome back to the channel. My name is Hans Nielsen, and today we're going to look at a topic that I get asked about a lot. That is something called IPOs, or initial public offerings. We're going to look at exactly what is it. We're going to look at if it is worth investing in, and I'm going to give you my completely honest answer as to if I have ever put any money into them and how it turned out. Alright, so hang on to the end. I am giving you my assessment as to these IPOs as an investment vehicle for you. First of all, an IPO stands for Initial Public Offering. And what is that? Well, imagine that some sort of company has been started. It could be a completely new or a bit more seasoned company, but it is a company that is just going about and doing its business and hopefully earning some money. But there are some owners in here that are working hard probably to get this on the road. But at some point they might need some extra cash. First of all, it could be that they were getting something in called seed capital. That is from investors that are quite sophisticated, that are looking for companies to put money in and then hoping that at some point they can take it public and cash out. But we have a new company, we might have some seed capital, not necessarily, but at some point they want to take this company public, meaning that they will take it on the stock exchange and we can have some stocks that you and I can buy. Alright, so at one point we are taking it public. Now, why would they want to take this company public? If it is such a good company, why not just have it for themselves and cash in every year from the profits? Well, there are several different reasons. First of all, they might have had some sort of exit plan so that they are cashing out, and it might have been their plan to build this company and say, well, in 5 or 10 years, when this is giving us a good profit, we are cashing out and putting X number of $1 million in our pockets. That's fair enough. It could also be that they are actually a very good company, but they need some money for growth. So they need something to spark their growth. They might be located in United States, but they want to branch out to Europe and China and Russia, and in that process they need some capital to grow. That is a fair argument. It could also be that they want to hire better people, a better CEO, some better engineers or whatever, and there's no doubt that there's a bit more status in being a public offered companies that you can buy shares in, and you might be able to offer some options, some stock options for your high level executives there. So there are a number of reasons why it could be fair enough to take a company public. However, when they're taking it public, do we want to invest in it? Well, why would we? Well, it could be that it is some sort of new hot technology. It could be like Tesla with the electrical vehicles. It could be Facebook with some new technology. It could be Twitter, or it could be whatever it is. It could be something where we say, I think there is potential in this niche, in this sector, that it could really take off and be the leader of this niche. Or maybe it's an entirely new product that has never been seen before, and you're thinking, well, this might gonna revolutionize the world and I'm gonna be a billionaire owning a few stocks in this company. Well, it might be. It could be a hot brand. It could be, of course, you're going for the profits. And what we're going for here really is often not 10% per year or 12% per year. No, what we're going for here in the IPOs are often thousands of percentages, because when people really realize that this new tech can revolutionize our lives, then it's gonna go through the roof. At least that is the fairy tale that we tell ourselves. The question is this a good investment? Well, probably not. Well, I saw a large research about it, and I'm just going to get the numbers straight, because It was some economists that looked at all the IPOs that were made between 1991 and 2018. There were approximately 7,000 of them. If you had bought into every single one of these 7,000 IPOs, you would have made something like 7% per year. That's not what we are going for when we invest in an IPO. We're going for thousands of percentages. But had you taken all the IPOs, you would have made roughly 7% per year from 1991 to 2018. In the same time, the Russell 3000, the index they compared it to, were up around 9%. So that was not particularly good, actually. And another thing, if you remember my video about risk, we also want to look at something called the standard deviations. And the standard deviations here were above 27%, whereas in the overall market it was only about 14%. So putting money into IPOs would have been a lot more volatile investment, and you would have risked a lot more of your money. Okay. So why would anyone invest in them? Well, as I said, there are of course the thousands of percentages that we are going for, but it is also often that I hear people go into these IPOs because of an ego issue. Because there's nothing nicer than to sit at the family dinner or with your co-workers and tell them about this new hot technology that you are investing in. And if it is a profit of thousands of percentages, of course you're telling everybody about it, and you are the genius investor of your network. Okay, but my thing here is that investing should never be done with your ego. As a good old saying goes, investing should be just about as boring as watching paint dry. So if you want excitement, you should take your money and go to Las Vegas. Put them on a casino. Alright, so if you use the IPO process as some sort of ego booster, and you can put on your Facebook page that you were in this or that stock in the beginning, then you're doing it for the wrong reasons. And if you remember my video about the risk management and do you know your risk, then we also know that we are talking about something called positive expected value. And there is some sort of positive expected value here in the 7%, fair enough. But in the meantime, when you put money into, let's say, 50 different IPOs, you could expect loser, 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 and then one very large success, and then loser, loser, loser. So you're gonna have an extremely volatile portfolio, unless you are such a sophisticated investor that you really know what you're looking for. But I can say up front, I never ever touch IPOs because I don't know what I get. Well, you might say, I could just read the financial statements from the company, and I could read the CEO's assessment of the future and the product and so on. Yeah, well, it's not to say that they're all lying, but to be honest, if I'm going into a car dealership and I'm asking the salesman, do you think I need a new car? It's quite likely that he would say, yes, Hans, I think you need a new car and I have just the right one for you. So if I were to listen to someone assessing a company and its products and the future of the products and the profits, I would probably not listen to the guys owning the company or the guys that have put money into the company at an early stage, or the investment banks that are making a killing out of taking this company public. It's not to say they're liars, but I think they are biased. They are seeing all the potential, but maybe not all of the threats. So what I like to see, and that is me personally, I like to see a couple of years history, at least when I'm buying a stock. I want to see how the stock price is doing. Are the large investors really coming in, or are they cashing out quickly? I like to see some financial statements that are not just statements from the owners, but are actually statements where individual neutral analysts have taken it through their analyst machinery, Excel arcs and so on, and had a look at the numbers and saying this is good, this is bad, what is the overall prediction of this company. I don't want that prediction to come from the people that is going to make money from me buying the stocks. So let me give you a couple of examples as to how some of these IPOs have gone. Some of them have been great, some of them has not. But let's have a look at it, because I have a couple of ideas as to how you can go about this. Let me drop into my laptop and just give me a second. Very good. We are at the laptop now, and as you can see, I've started out with something called Slack Technologies. You might know it. It is this software that you can use to communicate with co-workers and so on. Well, the Slack technology went public here at a starting price around $38. It did go up, and if you were really quickly, you could have cashed in 4, 5, 6%. But after that, and this was in June 19, after that, it just went down. Right now, it's down about 50%, and had you put your money into this, well, you could have had a lot to talk with your co-workers about, but mainly discussing how much money you had lost. So Slack technology would have been a terrible investment. Let's have another look at some of the others. That could be, for instance, GoPro. That is a company that a lot of people have invested in because it's cool, and they have this sports and adventure people, and it started out as a fantastic investment. It went public here in 2014. If you were in the market at that time, you might remember all the buzz about it, and it went from around $30 and up to $100, and people were talking about this one going to the moon. Well, fair enough. And some people might have cashed out a couple of 100%, and that was really great. However, most people held on because everybody was certain that this one was going to 500 and 1,000, so why would you sell out? And that is one of the traps you could easily fall into when you're looking back in time here, for instance at GoPro, and you could just take your ruler here and saying, yes, I could have made what, 200%. Yes, you could, if you had sold right at the right time. But if you had just kept it for another year, you would be down pretty much to break even. And had you held onto it up until now, well, what are we down to? We're down to around $4. So that one was an IPO that started out very nicely, but then the company really didn't show what everybody expected. But this one was an example of one where you could have made money if you were lucky to get in with a big chunk of money here in the beginning and you got out at the right time. The thing about getting in with a good chunk of money here is also that there is a very clear history that when these IPOs are going on, you're not getting all of the stocks that you're signing up for. So they are allocated into all of the people that are looking to buy the stock. And there is a very clear tendency, and this is not some sort of conspiracy thought, this is just basic facts, has been proven time and time again, that when an investment bank is offering a company out on stocks, they are giving their best customers the largest chunk of shares, and especially when it is a good and solid company that everybody expects would go up. And it is also very clear that when we are seeing a company that the investment bankers are a bit more doubtful about, then they're giving a larger chunk of stocks to the retail investors that are not their biggest customers. So they are trying to keep their biggest customers happy by giving them most of the stocks in the best companies. That's kind of a fact. Very good. On to the next one. This is SciPlay. It's a fairly new one, starting out here in 18, and that was in April 19 here. And right now it did go down to 8, so that was cut in half, more than cut in half. It went up to 13 again, and right now it is at 11. So did you get in here, you would have lost about a third of your money. Let's go on. Uber Technologies. We all know that one. Started here at 42, went up to 47, and then crashed completely, pretty much cut in half as well. Right now it is moving up, and we're gonna have a look at that in a second, what happens with these IPOs when they start to move again in a positive direction. I have more. I have Lyft. That is one where you should have been very, very lucky to cash in anything, because that started out here around 87 and just pretty much crashed instantly and are almost cut in half by now. Snap, we also know that one, and here is a stock that has gone up very, very nicely from the bottom. Not from the start, but from the bottom here we could have made 200 or 300%, and that is one of the points I'm gonna make here, because if you had bought Snap in the beginning here, you would have gone in around 24, and then it crashed down to 4 or 5. So you lost pretty much all of your money. But what I am doing in stocks now, I'm not in Snap stocks, but what I would have been doing here, and you know that if you have been looking some of the videos from my channel called Learn My Strategy. Because what I'm looking for is, I'm looking for stocks that are in an uptrend. I'm using the RSI down here to see that. We can see that the uptrend started around here, but I'm also looking for stocks doing better than the overall market, meaning that Snap got into a green zone here around $12, $13, and that is where it was allowed for me to start buying. So instead of buying at some unsecure, pretty much vague moment here where we don't know anything about the company at 25, I could have just waited it out until I saw that now we got some financial statements, there might be some positive surprises, and then I can get in. I'm never getting in around 5 or 6 down here at the bottom. It might go up 100% before I buy, but that doesn't matter, because I could have gotten in around 12 or 13 and now see a 50% move to the upside. If you had bought at the IPO here, you would still be down something like 20%. So in my experience, it is a very, very good thing, at least for new retail investors, amateur investors, and we are all a group of something that the large investors are calling dumb money. So it is good if you're part of the group that I'm also a part of called dumb money, meaning that we don't have all the information to wait until we see a clear trend. We are not going in just because we like the Snap platform or we use it and we are thinking, well, I'm using it every day and I know a lot of my friends are using it, so it must be a fantastic investment. These two things has nothing to do with each other. It can be the most fantastic product, but it never makes money. So let's have a look at another one. Groupon, you might remember that one if you have been in the game for a while. That is a bit of an oldie here. But it goes back to 2011 and went public just shy of $30, $28, and it pretty much crashed instantly. So over the next half year or a year, it went down to $2. Then it went up. We might actually have gotten in here with my strategy where we're looking for uptrends. We might have gotten in here and out somewhere here in break even, but then it just flatlined, and right now it is just below $3. So had you put $10,000 in here, you would be down 90% now, and your money would have been tied up for 8 years. So not very smart. Facebook, wow, that is one we like, and that is one I have made very much money on with my trend following strategy. But let's have a look at the IPO, what that one said. Well, we could have gotten in here in 2012 around $42. And then what happened? Bam! Went down to $16. You would have lost something like 60% of your money. And then it slowly started to make an uptrend. And around here, as you can see, it went into green zone around 36 mark here. The one taking the IPOs would still be in quite a heavy minus here. But we could start investing because now the trend had shifted. So even a company like Facebook, where we can all see that yes, in retrospect that was a fantastic company, but we didn't need to buy it at the IPO. Why not just wait it out and wait until the large players are getting in? We could get in at 36 and I actually got a sell signal up around here on 155 or so. We could have gotten in, maybe lost a bit of money here on this drop, but now we're in it again here from around 188 where we got the buy signal. So you don't need to be in on the IPOs, having your money sitting sleeping here and losing money and don't know anything about the company. But over here, a year or two after, it began to be obvious for investors that this is going to be a nice stock to be in. So I bought it and earned quite a lot of money on it. Beyond Meat is a new one, and this is one where it also took off right away. That is this one making, could I say, fake meat or something that is not animal based. It started down here at just above $40 and it shot straight up to 240, and everybody in all the Facebook groups I was looking at, they were certain that this was going to 10,000. Well, they're not so certain anymore, because then it dropped to 33. And the thing is that a lot of the investors that didn't get in here, they get tricked in up here at 100 and 120, 140, when all of their co-workers and family members are telling them that they are buying a complete new kitchen for the profit they have from Beyond Meat. And you're thinking, wow, I also want a new kitchen. And you buy it up here and all of a sudden you're sitting with a huge loss. Right now it's turning a bit upwards, but it is way too early for me to say if this is just temporarily and it's going down, or if it is actually starting to build an uptrend. But if it is starting to build an uptrend, I might be interested getting in around 150. I don't know. Right now it is 114. But if it is going to 10,000, I have no problem in just getting in at 150 instead of 114. So don't be impatient. Give a stock the time it needs to mature, and then get in when you think the trend is ready. Let me see. Oh yes, then of course there is the cannabis sector, the weed stocks. You could have made a killing on, for instance, Tilray. That one started at 24, and I know several of my friends that were good/lucky to get out when they had something about 1,000% in profit up here. But most investors actually got in up here around the 200 and 220 mark. Right now it is dropped 90-95% from that point, and it never really came to a point where I was interested in buying. I got my sell signal here with the red arrow, but of course it was a bit annoying for me to see that everybody was making money here, but I have my strict rules and I pretty much never break them. It is at least very rare. Of course, I feel like breaking them when I can see something going to the moon here, but I had to wait. And at some point, maybe Tilray will start building an uptrend, and then I might get in at 50 or 70, but that doesn't matter if it is a good, sustainable, long-term trend. Again, Canopy Growth here, also one of the companies. That one didn't drop instantly, but if you look at the start here, around in 14, you could have invested here, and then your money would pretty much just have gone to sleep. It started in $2, and a couple of years later it was, well, maybe at 250, 260, but it was just kind of flatlining here. Of course, if we're zooming in, we can see a bit more movement. I was starting to see a trend around here, around the 3. I didn't go in because I didn't like the sector, the niche here, but I could have gotten in if I had taken my signals here at 3, and then I might have gotten out somewhere here around with 100% profit, and I was getting new buy signals around 8, and then I could have taken it all the way up to, I don't know, somewhere up around here, around 33. You can see I never get out at the top, but I could have made several 100%. And I didn't need, I hadn't any need to get in here at the beginning of the IPO. So I think you're starting to get the picture. We are back at Slack here, so I've seen all the examples here. Some of them are making money, but if you need to be consistent with making money most years, you need to stay away from these IPOs, because you need something where you can say, I know pretty much what I'm making on the winners I'm having. I know what I'm losing on the losers, and I have a bit more winners than losers, and I need to build some profitable strategy that is good in the long run. Of course, we could have found stocks back from the 1998, 1999 that had also produced thousands of percent of profit, because that was kind of the wild west of the internet and tech stock. So these bubbles are coming, as well as in cannabis, and they did in 3D printing some years ago. But if you want to be consistently profitable, and you need a pretty steady equity curve where you can see that your money are growing year over year over year, then as a retail beginner investor, at least, you need to stay far away from the IPOs. You should not touch them. No matter how tempting it is and how much your neighbor is making on it, you need to go for the boring, long-term, stable gains. At least that's my opinion. I hope that made sense to you. I will get back to you soon with some more videos about my strategy, learn my strategy and so on. If you haven't done already, remember to subscribe to the channel, hit the like button, all of that stuff down beneath the video. I'll also be putting some links to some of the technology I'm using here with TradingView and so on. That's all for now. Take care of your money out there. Talk to you again soon. Bye for now.